I think the most interesting thing here, Bob, and thanks for joining us, is that you're going to counsel your clients differently because of Ellen Kuhlman and DuPont's victory here. They worked their tails off and actually beat these guys. And typically, these guys scare boards into the corner, and they win every time.
Yeah, in this spring, there were, I don't know, probably dozens, I think, of circumstances where somebody would show up with a 13F, which is a SEC filing on 1 or 2%. Next thing you know, the board would change. No proxy fight, no poison pen letters.
Because the board doesn't want to deal with the proxy fight, right? They don't want the scrutiny. They don't want all the problems.
And part of that was, and a big part of that was, there was a presumption that whatever the ISS, which is a proxy rating agency, and Glass Lewis, a similar one, said that all the institutional shareholders would follow it like lemmings. They didn't in the DuPont case. Now, DuPont obviously is a very well-performing company. It had an advantage that most companies don't have, which is a lot of retail ownership, almost a third.
Right.
That was a big factor. But what it did show is
a lot of index funds.
Yeah, but if you work the buy side, so-called buy side,
right,
your shareholder base beforehand, you're not necessarily, it's not preordained that what the ISS says is going to happen. And because usually in that first meeting is, you know, the guys like me, but also proxy solicitors say, okay, here's how the vote's going to come out based on a presumption of the ISS vote.
And that is what Kuhlman did. She worked the retail investors, and that's why you think this is an inflection point. And
she worked the big institutional shareholders. Vanguard, BlackRock, State Street, and all the rest. Now, it's not provable, but the assumption around my community is they went with the company.
Now, I think this,
and against ISS.
I think this dovetails well with, Nate, your report in Bloomberg Brief on the big performers, because activism has been so hot up to this point, right?
Absolutely.
That pension funds, that CalPERS is thinking about it, that this Florida Retirees Fund is thinking about it, and they're putting together lists of the biggest winners and losers.
Correct. Yeah. So Florida State Board of Administration, which administers Florida's pension, they put together this list of the top 100 best performing activist hedge funds. And interestingly enough, a lot of these were small funds. The top of the list is Iroquois Capital, which is, I couldn't even find a 13F on them, for example. I think they're only about 150 million. And so, which shows that activists are getting involved a lot more behind the scenes and a lot more with smaller companies, which is, I think, something that you could watch, to your point.
Yeah.
Well, which maybe shows that the trend has peaked. You know, I mean, that's what I was.
Or it might just be getting bigger.
To the question of performance, Nelson Peltz will say that since he got involved with DuPont, the stock is up 20%, and they did a lot of things that he was pushing for, including buying back $5 billion in shares, cutting $1.3 billion in costs, and maybe he didn't get his people on the board, but he'll say actually his involvement in DuPont was a success.
Yeah, and Nelson Peltz is on this list. His fund returned 48% in their activist situations, according to the SBA. So he's done pretty well, absolutely.
Yeah, and frankly, that's part of the fundamental change. It used to be the first meeting was, how do we beat these guys? Now that was the question. Now the first question is, are they right? Or are they right in part?
Which is what it should do. I mean, that's what good corporate governance is, right?
Yeah, and it's more director-driven rather than. Now, I'm not saying that there's necessarily tension between management and the board, but it is director-driven. And so rather than saying, what do we have to do to beat these guys, we say, well, maybe something that they're saying is correct. And by the way, this is in a more general context in which big institutional investors, I think, triggered by the Larry Fink letter last March, where he basically said, don't just buy back your stock.
Right, don't just buy back shares, try to actually grow the company.
Are more thoughtful about capital allocation and all the rest of it, and open to listen.
Well, so isn't this a good thing?
Of course it's a good thing.
I mean, Jones Day represents the biggest corporations in the world. What are your clients telling you about this example?
Well,
how are they reacting?
And one other part of the story is maybe you need to change your IR functionality some. Instead of focusing just on the sell-side analysts, you know, the investment banks and all the rest of it, you really ought to deal with the people who actually own your stock and explain your strategy in a way that, kind of a 21st century way, which is not just how did we do year over year earnings and all that stuff, which is, you know, what's kind of fueled the buyback phenomenon, but what's our strategy, how are we allocating capital, and why should you stick with us?
All right. Thanks, Bob, so much for joining us. Great to get your insight on this. Partner at Jones Day, obviously. And Nate Baker, thank you so much, editor for Bloomberg Brief Hedge Funds.